Well, good afternoon, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining us this afternoon for in a low interest rate world, is the carry trade dead? Now, I'm having problems with that today, but I'm sure Tim won't. But first, before we do get into this, I want to thank the CME group for making today's event possible. So what I'd like to do is actually bring Barbara Schmidt-Bailey on and to talk about a joint effort that we have with the CME group, and you can access that information from our website. Now, what I'm going to do is actually share that information with you in a browser. So, Barbara, if you can unmute your phone, let's start talking about the website here today.
Okay, Cynthia, we'll do that. Thank you, everyone, for joining us. My name is Barbara Schmidt-Bailey at CME Group. And before we get started, we just wanted to draw your attention to a new site, or a new portion of the Interactive Brokers site that CME Group and Interactive Brokers have built together. We call it our Futures Resource Center. You can find it at interactivebrokers.com/CME. And this is basically a site that we feel can be your starting point for everything that you might want to know about futures, from some charts, simple charts, and market information, to market news, analysis, free quotes, product information, anything that you might need, you'll see here listed. Also, the webinar series that Interactive Brokers offers you, a daily futures report from Dan Gramza. As we go on, this is a new site. We'll be adding video information, 101 information, to more advanced information on how to trade futures. So we feel, again, that this is just your starting point for futures, brought to you by Interactive Brokers and CME Group. And please take a look at that. Give us any information back to Cynthia on if there's content you'd love to see added onto the site, or what is useful and what value it brings. We'd love to hear it. Our speaker today is Tim Morich. Many of you know Tim already, and if you don't, we'll just let you know that Tim has been a professional trader, author, educator, and mentor for more than 35 years. Besides trading his own capital, Tim is president of Blackthorn Capital, a private money management firm that works with several of the largest non-U.S. institutional portfolios. Tim has been a member of the CME Group also for probably about as long as he's been trading, and he has taught hundreds of professional floor traders at CBOT and CME to become successful off-floor electronic traders. Tim shares his time a lot, both at the university level and down to grade schools, to his students, to his website, marketgeometry.com. We're thrilled to have him with us today for another presentation. Today on whether the carry trade is dead. We will be also, or Cynthia, I should say, will be posting soon information on a March event with Tim in our ongoing series of educational events brought to you by CME Group and Interactive Brokers. So please enjoy the presentation, and we'll look forward to seeing you at another event soon. Thank you.
Hi, Barbara. Cynthia, I hope everybody can hear me. Yes?
Hear you loud and clear. You're a little bit weak there, Tim, so if you could move your voice or move closer to the phone, I think we'll get a better signal.
Is that any better?
Oh, sounds much better.
Okay. I've got the microphone inside my mouth now. Anyway, good morning, everybody. Let's see. I wanted to start out. First of all, happy Valentine's Day to my two favorite women in the world, Cynthia and Barbara. And we have been together for a very long time. You know, not supposed to say that about young ladies, but let's see. Cynthia and I have been doing this for more than 5 years, and Barbara brought me into doing online education quite a bit longer, further back than that. I used to do a 15-minute session at the beginning of the CME day every morning on the internet, and then we started teaching, as she said, individual CME professional traders in 2005. So it goes back quite a long time. We're actually going to recreate that and begin doing pre-market teaching for a select 25 people. Going to bring the idea back. So Thank you, Barbara, for the beginning, and we're going to reach everything old is new again, I guess is what they say. So happy Valentine's Day to all of you. Let me just do my personal selections. There we go. I've got my little counter there. Happy Valentine's Day to all of you. Again, my educational site is marketgeometry.com. I'm pleased to say that I'm speaking with several, what's the right word? College prep academies, high-end high schools today that wish to have the type of programs that I do at MIT, Stanford, and the University of Chicago. They want to do at the high school level. So it looks like I will be teaching high schoolers next year via the internet, and that ought to be a lot of fun to see what that's like. Fifth graders was a blast for 4 years. We do not have funding for next year. I don't know if we'll pick it up, but high school seems to be on the agenda, and we'll try that. I haven't tried that before, other than my son and daughter, but we'll see how that goes. Whenever you talk about anything that has to do with financial instruments, of course, you have to have Forex and futures risk disclaimers. I'm sure Cynthia's gone through all of Interactive Brokers. They, of course, do all kinds of compliance checks on me and also the material. One thing I'd offer here that I always say, there is no holy grail. If you came here today looking for it, expecting me to give it to you, I don't have it. If I had it, I'd give it to you. Hard work, education, practice, those are the things that will make you a success in this business or any business. And this is a business, by the way. So with that being said, we're kind of following along with the CME's economist a couple weeks afterwards. And he recently talked about fundamental data and the carry trade. And interest rates in the major world economies have converged to the point where they're almost all at zero. And the question is, large hedge funds, people like Mr. Finks, who has a little over $2.75 trillion under management, he relies on things like carry trades. You got to park your money somewhere. Is that dead now? Now, the funny thing about doing presentations like this, at least from a trader's standpoint, I don't know if you all know, I also have a PhD in economics and math and physics, so I'm certainly aware of the economics of the situation. But I make my living as a trader. I'm a sovereign wealth fund manager. And so when I think about this as a trader and put together a presentation like this, the first thing that goes through my mind is, okay, so how do I approach this, and how can I talk to all of you about carry trades? And the honest truth, for those of you that signed up looking at this, we'll go back to the screen. Just for in a low interest rate world, is the carry trade dead? So that's where we're at. The honest truth is, as a trader, I don't really care. It's meaningless to me. If there's a trade there, I'll take the trade. If there's not a trade there, I'll find something else to do. So we're going to take a look today at how I actually do analyze trades, and you're going to get a view inside what we do live with people that we mentor or people that are going to be taking this new pre-opening market session, which is for 25 people only, or people that come to the premium membership. This is what we do live every day. This is how we analyze trades. This is how we drill down. And this is also what I do in my own portfolio as well as for the people that I manage money. How do you take a look at trades? So let's take a look at that. And that'll kind of answer the question for you. Is it dead? Does it matter? Let's just take a look. So I've been a successful trader for a very long time. I'm going to show you how I use my own technical analysis tools to frame my trades, no matter what fundamental issues have changed in the world. I just don't think about fundamental issues anymore. Let's look at the Euro FX US dollar pair. That's the largest currency pair traded in the world. So let's just start with that. So this is a typical chart that you would see, especially on a forum, people that have discussed the type of market analysis, market structure that we teach at Market Geometry, my partner Shane and I. And what we marked out here is we've got a big important range here. And by the way, it's not noted up here, but this is the 20-minute, 24-hour session Euro US dollar FX futures, okay? So we've got a big, huge range. We break out, come down. When we take out that high, that makes this a swing low. Come down and leave a low. When you take that out, that makes this a swing high, makes this a swing high. You have to leave one to take another. It's a back and forth motion. So you can see the swing highs and the swing lows being created. We spend lots of time talking about market structure because market structure is where people hide their stops or their profit orders. And especially large traders, people that we call whales, and I would certainly qualify as one of them. You know, most of the markets I trade in the time zones that I trade, I'm one of the 3, 4, 5 largest traders in the world. So where I leave my orders, it's generally important. So we follow those. We call those whale tracks. Well, one of the most important things you need to know is where would somebody or where would the whales be looking to buy or sell? Well, one way to do that is this swing analysis. Swing high, swing low. Swing high, all the way down to swing low. Swing high perhaps takes out this low, so maybe we do think this is a swing high. Swing low, we don't know because, of course, it's doing something. We just don't know yet. Now, I want you all to do me a favor. Today this is going to be very interactive, so I need you to put your thinking hats on. Generally, I tell you just kick back and let it just kind of flow through. Today, I want you to participate. So I want you to literally roll your chair back 3, 4 feet. Take a nice long look at this chart. I'll give you a second to do it. Now, each of these bars are 20 minutes long. And this is a lot of data. In fact, this is over a month of data, 20-minute bars. And each time frame has their own set of players, so to speak. And one of the things you should think about is, are the players that are tuned in on the 20-minute chart, are they really thinking about what happened a month and a half ago, or 2 months ago, 6 weeks ago? Think about that for a second. Now, you'll see charts like this, especially by people that have read my material. You've seen charts like this that I've drawn, for example. There's a famous chart from right before Lehman Brothers fell apart. I did live on Traders Expo, and of course the video went viral, and then also the charts got passed around quite a bit. This looks very much like the stock market right before it collapsed, and I had a live interview. Somebody asked me, Tim, a good friend of mine, Tim, asked me where the Dow was going, and I told him I thought it would go to 7,200. If that broke 5,500, he said, don't know, the Dow Jones, which is at 13,500. I said, yeah, exactly. The chart looked very similar to this, and it was very scrunched in. So you do see charts like this sometimes from me, and you can see this median line, high, low, high, or ABC. Price is doing a fairly good. It came back and retested up here, and you can see it's working its way down the median line down here. So there's nothing wrong with this median line, per se. Let's close in a little. Let's move in a little closer and take a look. Let's go back just for framing it. Now let's just scoot in a little more. And we can see the touches. There's the retest on this median line. Here's the touch here on the center, touch here on the center. We break through, then we test it, come back. As we break back above it, we come back and test it from up above again. Now we test the median line, break above it, come back and test it, break above it, come back and test it. So this median line is doing okay. And you can see I added a new blue upsloping median line. But again, this is a lot of data. These are 20-minute bars. So many traders that have studied my methods. Look at the market with this much data on their screen or chart. And I've certainly shown charts with this much data in the past. At times it was to show potential support or resistance areas in the market structure. I'm going to be honest, at times I was showing trades. But like everything in life, as you learn and progress, the way you use your tools changes. And unless I'm looking at longer-term portfolio-style trades that may last for months, I use much less data, much less data. I no longer pay attention to the fundamentals of the markets because with the advent of the Internet, that same information is available to everyone and at the same time. The Internet's so fast. So I don't feel I have an edge when I'm using fundamentals. When I was a commodities corporation, I taught there, you know, we would have people out in the cocoa fields, for example, with, you know, satellite phones, not cell phones. They would call in from out in the middle of nowhere to tell us the pod count, and we would have a 2-week edge on the rest of the market. It doesn't exist anymore. It's just not the way the world is. The information age just changed all that. So I've always believed anybody that has information faster now, by the way, means they're trading, they're an insider trader, and it's illegal. So, of course, we don't want to do that. I've always believed that everything you need to know is contained in price. And recently, I've been emphasizing that concept more and more in my teaching. I find that the charts I use when trading and the charts I use when teaching contains much less data than what most traders rely upon. I believe that you really only need the current price action and the last important swing on your chart. So let's try this again. Euro FX versus US dollar. And we're going to try and wheedle down the amount of data. So here's the original chart. Here's our red down-sloping median line. You can see the touches on it. Here's our blue up-sloping median line. Then you can see I put in a framing box, this green box, and we're going to use this. Let me do one thing before I get to the interactive part. Can you guys hear me? Just give me a yes. Okay, so everybody's just listening. Okay, good. Okay, that's fine. Thank you. All right, so we have a framing box, and we're going to use that because we want to know where we are versus this big scrunched-in chart. Well, I'm not going to take questions now, just so you know. I'll take questions at the end because otherwise we'll never get done. Just let it flow. All right, so see the box? This is the box blown up, so to speak, zoomed in. And even still, so you can see your 20-minute bars. Look how scrunched in together they are. And to try and do analysis and say, well, here's a retest and here's will be my stop, or, you know, went through the swing low by X, very difficult. So here we are. Let's zoom in a little bit more. And again, here's the same red down-sloping median line. Here's the touches that we talked about. Here's our blue up-sloping median line. Here's our framing box in green. It's still a lot of data. Let's take a look. It is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, I don't know, 15 days worth of data, something like that. Occam's razor is a principle of parsimony, economy, or succinctness used in logic and problem solving. It states that among competing hypotheses, the one that makes the fewest assumptions should be selected. Now, I find that if I evaluate the market using less data and relying on fewer assumptions, for example, lines, my trades are cleaner, and they're much easier to evaluate, and they're consistently more profitable. Ever heard of the simple statement, KISS, keep it simple, stupid? A lot of my traders used to put that up. Now, less is more, sure, absolutely. So here we are with less data. Don Christmas says that's too general a principle for me. Okay. Everybody, it's fine, Don. It's okay with me. Maybe it's too simple for you. How's that? Here we are with less data. Let's just take a look. We made a low, and here's our green window, by the way, dotted. So just remember where we are. And here's our blue line. This is our lowest low. Price came up, made a nice high, left double bottoms, travel back up, and you can see if you just drew in a center line, the highs are about equally matched here. Came back down, couldn't take out the double lows, the double bottoms here, left to tap. Now we start to take out the swings to the left. We finally take out this high, prior high. That makes this a swing low when that happens. We come up into this area, leave a high, trade lower. Here's our first drive to the bottom. Trade back up, and really, if you look, we're just consolidating. Trade higher, run back down, take out this low. That's the second drive to the bottom. Head higher, but don't take out this high. Again, you can draw a center line and take a look. It's pretty much containing the move to the upside. Now we drive to the downside. And what do we know about the median line? The median line should act as a trend barrier. It's where price should run out of energy, out of downside energy, if this median line is any good. Let's take a look at the median line. Did a fairly good job cutting through the action here on the handle. Again, here, does a fine job cutting through the action on the handle. Look at the BC line. Again, the slope is very nice. You can see the slope is great against these tops, cuts through the action here. Take a look at the touches. Take a look at all the touches here. I expect that this median line will be interesting. 7, 8, 9 bars, 20-minute bars later, we're testing for the first time the lower parallel. So this is what we call the first pendulum pullback. A lot of times this is the place where if you get in, the early place to get in, this is where you make the most amount of money if you can afford the stop loss. So let's take a look at the stop loss real quick. Stop loss. We could simply go underneath the lower of the 1, 2, 3 drives, certainly underneath the C point. Maybe that would be here. An even better one would be if we could afford these double bottoms. Of course, a great one would be if we could afford the A point. But that all depends on your risk reward and how much you risk per trade. But all that needs to be in what you're considering. But as I look at this, anybody guess what I'm thinking? As I take a look at this, better stop loss, long. I'm thinking of things much more simple. Not enough information. Okay. Why a bottom? No, I'm not driving anymore. I can't draw anymore. That's not the point. What am I thinking? Nice center line. Okay, yeah, sure. Buy another bar. Okay. How about something more basic? Even more basic. Okay. I'll do it. Ready? Occam's razor is a principle of parsimony, economy, or succinctness used in logic and problem solving. It states that among competing hypotheses, the one that makes the fewest assumptions should be selected. I find that if I evaluate the market using less data and relying on fewer assumptions, things like lines, my trades are cleaner, they're much easier to evaluate, and are consistently more profitable. Do I need this much data? Do I need to rely on assumptions from bars far enough back in this time frame that the larger players of this time frame are no longer using them on their charts? Think about that for a second. If the large players in this time frame are not looking at this much data, do I want to look at this much data? I could, but it's not going to give me an edge. Always remember, I am looking for an edge. Can I identify where the significant buyers and sellers from this time frame are in this market? Where are their orders? You don't have to be a whale to take advantage of this. You can swim with the whales once you learn to read the tracks, which is what we're going to try and teach today. What are the big players looking at? Well, pay attention and you'll see. Let's try it again. Observe, make conclusions, and prepare. Simplify, 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 then act. Okay, so this is still too much data. This, I believe, was blue before I changed it to green. I'm not sure why. It was 2 in the morning. Probably got lost in the color scheme. But I put in some markers just so you know what this is the last touch on the handle. Here's the B pivot. Here's the next touch on the handle, so I know the slope of the handle, which will also give me the slope of the parallel lines. And here's the C point, and we were talking about a test and retest. That's right here. So you can see I've marked this so that we know if we change the amount of data, exactly where we're at, okay? Level 3 trading has nothing to do with anything. You really don't. You don't need to know if there's 4 bids or 5. These are all 20-minute charts. You don't need to know if there's 20 bids or 5,444 bids. This is meaningless. We're going to stay on 20 minutes all day. Otherwise, I'll get confused. It's always 20 minutes. It's going to be the euro against the dollar. So now we've zoomed in. Here's our B pivot. Here's our handle right here. The C pivot's over here. Farther on in the handle's over here. So let's do some analysis with a much smaller amount of data, something much closer to what I would use when I do analysis. So price comes higher, and you can see people are trying to sell here. Look at them, bump, bump. They get a rise, but not a really big rise, so they sell it again, bump, bump. They make new highs, and now look, the organized sell-off. Look at the highs, and the BC line does a great job of capturing the slope of this organized sell-off. And we get back down and bump, bump, bump it again. Try and go higher. We can't make new highs. Come down, bump it again. At this point, wouldn't you say it's a fact that there are buyers at this level right now? We come back higher. We can't even take out this high now. As we head lower this time around, oops, no buyers. Look at the line. We've done this before. We call this testing the door. The door is shut. You can't tell what's behind the door. You think the door will hold. You think the door is locked. You go over, the door is open. You open the door and you run through the hallway. So there were no buyers this time around. They closed their tent. So whales were here. Now they're no longer here. Price sells off. Price cracked the lows of the upper range and sold off hard. Take a look now. This is Andrews 101. If this was a median line, and we call this a multi-pivot line, price zooms through it. That's what this bar is, this wide range bar. When price zooms through a multi-pivot line or a median line or its parallels, it will, with 80% probability, come back and retest it. You can see it come right back up and retest it. Now, pay attention to the bars in this series after the sell-off. Someone has an agenda. Somebody asked earlier, what are the whales looking at? Well, you want to look at whale tracks? Watch this. Price sells off hard. We get another wide range bar lower. Look at it. But look at the close. Somebody's buying here. We get another even wider wide range bar lower. But look at the close, all the way back up here. Somebody's buying. We get another wide range bar lower. But look at the close. Somebody's buying. We come make a series of new lows. We probably take out some stops at this area right here. But when we make the wide range bar again, look at the close. Somebody's buying. All the wide range bars have higher closes. The wide range bars are where the activity, the most activity in the market is going on. Are any of you ready to trade yet? David does? Okay, David, what's your order? Buy where? Where's your stop? Do you have that much information? No, I don't. Yeah, I don't think you have enough information. So, David, the right thing to say is, I think I have an idea. Now I've got to do a little more observation. Okay? So let's see what happened. Here's our wide range bars, and they're closing higher. Now we settle, and remember this was our bump, bump, bump line. It was support, and now it's resistance, overhead multi-pivot line. This is that red line right here. So we just all know where we are. Here's our wide range bars that are closing higher. We work our way again into another range. And by the way, in the background, this was that large upsloping median line. We work into a range, and price is just stuck in this range. What do we have? We'll look down below. After the one wide range bar that closes higher, we come up, we leave a high, double highs, double tops, tap the bottom, tap the bottom, try to break out again on the upside, but close down. Try to break out on the upside, but close down. Try and break out to the upside, tap the bottom, buyers down here again. Now we close up here. Try and break out to the upside, close underneath. Try and break out to the upside, close underneath. Get frustrated, try and sell lower, tap. We're still closing within the range. What is it? It's just a range. It's an energy coil. We have buyers in this area. We've got sellers in this area. There were buyers here. There may be sellers here. So what do we know? We know that there seems to be buyers here. There seems to be sellers here. At the moment, it's a fairly tight coil. Let's take a look now. Bump, bump, bump. Try and take out the highs. Slide along, and all of a sudden, once again, it's like a matador with a bull. He moves the cape, and the bull keeps going. The buyers aren't there. The door opens up. You run down the hallway. You think the door's going to stop you, but it doesn't. You run down the hallway, and you're down here all of a sudden. Look at price sell off. Where are the buyers? That's what you should be asking yourself. You didn't have an opportunity to get short. So what you should be asking yourself are, where are the buyers? Where are the sellers? Where's the edge? Where's my opportunity? One second. Oh, I see my brother. I appreciate you coming. Dr. Andrews will be proud of us. Where are the buyers? Where are the sellers? That's what we're looking for. Now, let's do something simple. Here's our BC line from that huge median line from before. All I'm going to do is take that slope, copy it, move it to this high, measure the distance, flop it over the top. So this becomes the action line. This BC line becomes the center line. If I measure the distance and use the same distance, this is the reaction line. So this is an action-reaction set. And you can see it does a pretty good job showing us the bottom here. And as we come down here and approach it, we get down, and I've also doubled the range here. I've taken the measure of this high, this low, measured it, flopped it over. That's doubling the range. So many times you'll see price will double the range and stop. Well, what are we doing? When we double the range, we've basically set up a center line, an action line. We're going to measure the distance, flop it over. We've got our center line, our action line, our reaction line. We've also set up a action-reaction set again. And there's something called confluence. It means where things meet. Notice the close. Price came down, tested this lower reaction line, got very near this horizontal reaction line, and closed on its highs. Are you all with me? Okay. Asking that question also lets me get a drink of green tea. So, all right. So we're looking at the close. We've got two sets of action-reaction lines. Now pay attention because I'm going to have you make trading decisions, each and every one of you. We come down. Here we are testing or closing on highs. We come and we test what was support, bump, 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 bump. Then we zoom through. We test it from down below, and at the moment it's resistance. Okay? So now my question is, again, price has doubled the range. You can see we've tested down here. And now we're back at the center line of this green action-reaction set. Here's the question. Is this green action-reaction set the key to anything? Or is it simple coincidence? That's what you should be asking yourself. Am I drawing lines that have any meaning at all? Or is it just a coincidence that price is touching them? How can I know the slope? C is yet to be made. Michael. Let's see, I'm on slide 23. Ready, Michael? You see this red downsloper? See the red downsloper? See the blue upsloper and see the BC pivot? That's where we got that. But even if you're drawing it at this point and connecting basically highs and lows, you're going to have slopes that are basically the same. Good question. But that's where we got it from, okay? Certainly at this point, it would be easy to find. It cuts, the center line cuts right through the action, grabs the major highs, the major lows. And again, price has now doubled the range. And if you turn your head a little bit to the right, price has also doubled the range of the green action-reaction line set. Or you might want to think of it as a downsloping range. Another way to think about it. Until it breaks out of that, it's a sloping range. Okay? So now price breaks through and makes new lows for the move. So we take out the bottom. When we doubled this range, we take out the bottom of this range. And we even flirt with taking out the bottom of the reaction line. But look at the closes. Even as we take out the magenta lower reaction line, look at the closes. And in fact, as we go lower, even our lows are higher. Our closes are higher. There's an agenda here. Someone is doing something. Let me just whisper in your ear. Do you think there are people out there that sell to buy? Do you think anybody would be that devious? As a whale, I will tell you, I will do whatever it takes, as long as it's legal, to get the position I need and make money, right? So if I can push prices lower to run your stop loss and then buy it cheaper from you, I absolutely will do it. Anna, you're exactly right. Wash and rinse, yeah. I don't know if this is a classic wash and rinse, but the idea basically is take out these lows, there's some stops, I can buy all I want here as it comes lower. Go ahead, you sell all you want, I'm interested here. Look at the closes. Let's see what this brings us. So reality check, what do we know? Does anybody think that there are any facts? There's no chart on the screen. Does anybody think there are any facts, not opinions, not ideas? Do you think there are facts? Some people will say, okay, all right. History is a fact. I don't know if that's going to help me trade, but okay, I'll go with that. No facts yet? All right, let's take a look and see what I think. Fact. The sellers were at the overhead resistance multi-pivot line. Look at them, touch it. We broke through. We came back and tested it, sold off. Tested it, sold off. Since then, we haven't even been able to get up there. In my opinion, fact, sellers were at the overhead resistance multi-pivot line. And you can see us try and break above this multi-pivot line, top of the tight range. That's a fact. Sellers were at the top of that tight range. Fact, buyers were at the bottom of the tight range before it finally gave away. Now, down here, is this a fact? I think it's too early. I think it's an observation. On both legs lower, 1 and 2, the extreme bars all had closes in the upper third of their range. Does that lead me to a conclusion that I can call a fact? No, not to me. It's an observation. And Don says, your experience may tell you what is likely a fact. It is true that I may observe something and say, I've seen this before, and I have a feeling this will turn into X. But that doesn't make it a fact yet. Lal says, you're starting to get closes above the lower pink line. Yes. What does it mean? Don't know yet, but a good observation. Let's see what it means. Well, let's see where we get. What does it mean? How about that? But what does it mean? Here's our 3 pokes lower and the higher closes. What does it mean? It looks like somebody's got something to do, doesn't it? And the people that were selling new lows just got their chain pulled, right? These are probably stop-loss buyers. Somebody's buying, buying, buying. Nobody wants to buy except for one or two people. And out of the blue, they suddenly wake up as price eats away, and suddenly they went from a little profit or a nice profit to a small profit or maybe even a loss, and then they have to get out, and the door is very small. Price stopped at the lower reaction line. Price has now zoomed the center line. Price has now zoomed the magenta center line, or the center of the range. And again, I told you if you turn your head to the right, the green set of lines is a downsloping range. We've zoomed the center. We've gone from the bottom of the range to the top of the range of the green lines. Take a look. Turn your head to the right, everybody. Come on. I know you feel funny doing it, but I do it all the time. Turn your head to the right and take a look at that green range and say, yep, went from the bottom to the top. Get in the habit of thinking like that. What does it mean? Okay, it says 80% chance of a retrace. He's thinking back to this area, I assume, back to the center line. Okay. Looks like a pendulum swing short. Al wants to go short. Al, you want to go short here and put a stop up in this area? What's your profit target? Lal says too big a stop for you, Al, but we'll let Al decide it, but okay. Too rich for me, says Robert. Okay. Not enough info. Okay. All right. The risk reward is not good. I absolutely would say that. Right at the bottom of the fork. So you wants to get short here, top of the range, or the top of the fork, really action reaction lines, but the stop up above. Again, you have to have a stop on structure. None of this is structure. The only structure is right up here. So your stop's going to have to be all the way up here. Your risk reward is, it's 1-to-1, but it's not 2-to-1. So let's see what we get from it. What does it mean? I admit this is a cheap trick, everybody. This is the cheap trick. If I could do this in red flashing lights, I'll have to ask my daughter, Lucy, how to do that. I admit this is a cheap trick. I did this in a presentation, by the way, at MIT a couple weeks ago. I did a presentation online for them at the Sloan Business School. If you wish to know the answer, you must travel the road that I traveled, the road that Amos Hofstadter traveled, and Dr. Andrews traveled. And, of course, here's good company, huh? The road Sir Isaac Newton traveled. Are you prepared to declare yourselves, drum roll please, not Newtonians, who isn't? Like my mentors before me, including Sir Isaac Newton, I am an alchemist. Do you want to take the alchemist pledge? Anybody? Raise your right hand. You must type in, I am an alchemist. You can add proudly, if you wish. I am proud to be an alchemist. Oh, it's certainly legal, sure. They won't arrest you for it, it's okay. You'll be in great company. Sir Isaac Newton did not consider himself a mathematician or a physicist. He considered himself an alchemist. And he's pretty good company. We must travel this obscure road if we are to find facts out of simple observation. So when you leave here today, by the way, you can tell whoever's significant in your life, hey, by the way, did you know I'm now an alchemist? And they'll look at you like you've been drinking. But that's okay. And Barbara didn't type it in, but I know Cynthia did, but I'm going to actually officially now make Barbara an alchemist, just because we've known each other so long. So Cynthia and Barbara have taken the pledge as well. So here we go. No, we're not going to use mercury, sulfur, and salt today, but maybe another time. So we're all alchemists now. So as above, so below. This is the Bible of the alchemy world, and the greatest translation was by Sir Isaac Newton, the Emerald Tablet. You can find it on the internet. Just Google Emerald Tablet, Sir Isaac Newton, and you can see his translation. And in fact, his laws of motion come directly from the Emerald Tablet, which is, again, an alchemical treatment, thousands of years old. As above, so below. We're at the reaction line. Now we're back up at the action line. Now let's see how we can apply that as alchemists. Price doubled the range of the horizontal range. Now, almost every trader may be able to see that because, of course, they can draw straight lines. But price also doubled the range of the sloped range. Only those of you that have taken the alchemist pledge are able to see that. See, we have, you know how you go to the movies and you get those special 3D glasses? We have our alchemist glasses on now. We can see things that other people cannot see in the market. When you leave here today, it won't go away. You're stuck with alchemist views for the rest of your life now. Once I see the intent of this market, I add an upsloping blue median line to show me the probable path of price. How do I see the intent? I was blind, but now I can see. There you go, very nice. Once I see the intent, take a look at these two bars when we sprang out of the bottom, and look at the closes. This is the intent of this market. Somebody got some stuff to do, and it's serious. That makes me want to draw. You know, they say that makes me want to dance. This makes me want to draw. So I go to the beginning of the range. Remember this, we had these two wide range bars lower that closed on their highs. Here's my beginning of the range trading. I draw off the low as my A. The highest high within the range, we're trying to break out to the upside, is the B. And as we come down, and it's the confluence really of the green reaction line and the magenta reaction line, that's my C. So now I've got A, B, C. I can draw on a median line, and this gives me the probable path of price. As an alchemist and or a physicist, you would be familiar with sine waves. Price should oscillate around the center line or the median line. These are the edges. We want to trade at the edges, the lower parallel, the upper parallel. If we don't have alchemical glasses on, of course, we can't see the sloped lines. We're stuck in horizontal world or vertical world, but we've got our alchemy glasses on now. We can see the magic lines. So I've drawn in my new blue upsloping median line. If you're still following my logic, at this point, you notice that price closed at the highs of the last two wide range bars. Let's look real quick before I go any further. Take a look. Wide range bar closes on its high. That's the zoom of the center line. Wide range bar closes near its high. Tested the action line up above. You notice that price closed at the highs of the last two wide range bars. Observation is extremely important. I talked about that earlier on. Observation is extremely important. The first thought that comes into your mind is, if this really is the start of an uptrend, price will never come back to an area that will give me a quality entry. Let's go back and look. Put your trader's hat on. Everybody got your trader's hat on? You can leave your alchemy glasses on, but you got to have your trader's hat on. Okay, ready? When you're watching a chart like this, and this bar pops up like this, don't you always say, oh, man, that was the move. They're not going to let me in now. I'm going to have to get in like up in here now, and, you know, and then I'm going to have trouble with the top of the range. Isn't that how you feel? Dang, I hate when that happens. Isn't that how you feel? Yes? Come on, admit it. Sure. Of course you do. Price will never come back to an area that's going to give me a quality entry. Of course you feel that way. The world's always against me. It's stacked against me, and it's just not fair. Okay, but remember, we've got secret alchemy glasses, don't we? Shh, Matt, don't tell anybody that, because it may be put your alchemy glasses on. Make sure they're on. They always move the market when I'm not ready. Yeah, I get that, Lal. Okay, so get your glasses back on. I've done my favorite trick. I took the bars off. These are just the lines that we drew. Special specs on. Good, right? Okay. These are just the bars. Here's our center line. Here's our action line. Here's our reaction line. Here's our center line or median line, upper parallel or action line, lower parallel or reaction line. Okay? Median line, upper parallel, lower parallel. Think about that last bar. It just zoomed up like crazy and left us, we got nothing, right? We're wringing our hands. How am I going to make money if the market keeps doing this to me? Pay very close attention now. Price zoomed 3 median lines. Median line 1, median line 2, median line 3. Price zoomed through all 3 right there. And it says, we must hurry and buy now. No, the people without alchemy glasses, of course, do run to the market and buy now, and that's why that bar does that. But we don't want to do that. As my father would say, and I'm sure this is not a popular saying anymore, at this point we have to hold our water. Should retest what? But which one? Okay, which one? That's it. All things come to those who wait. Very good. Well, what's it going to retest? Andrews says, alchemist Andrews, Dr. Andrews says, if price zooms a median line or one of its parallels, price will come back and retest it with an 80% probability. How about that? Robert Baker likes this energy point. Okay. 80% probability price will come back and retest the median lines it's zoomed. Let's work with that. Let's think about that. Andrews 101. When price zooms, I guess can't even read my own work. When price zooms a median line, it will come back to test it. That is a direct quote from Dr. Andrews' 1965 tome, The Action and Reaction book. And it's on marketgeometry.com free. Don't pay somebody a ridiculous amount of money to read it. It's on our website free. Please, save your money for somebody you love. I've been doing this for many years and running the statistical analysis on it over and over. And as Dr. Andrews claimed in the 1930s, price will come back to retest a zoomed median line or its parallel 80% of the time. Now, in this situation, the sirens of the markets are singing to all of us, quick, quick, quick. Anna said it. Price is going up. Chase it, chase it. Come on, chase it before it gets away. Everybody wants to buy, right? Because, of course, it looks like it's just going to the moon. It's leaving without you. You'll never get another opportunity to buy. But trust me, chasing price action is one of the fastest ways to lose lots of money. Price acts like a pendulum. Swings up, swings down. Swings up, swings down. It breathes in, it breathes out. It goes to extremes, comes back to balance. The train, Albert says the train's leaving the station without me. It's okay, Albert. There's another train. It's like a rubber band. It's pulled out and then let go and it comes back. In fact, that's how Dr. Andrews tested this theory. They didn't use rubber band. They used stretchy string, and they measured how far they could pull it and what would happen to it. And they did thousands and thousands, well, tens of thousands of iterations, and actually found validity, mathematical validity. We can do it on computers. They actually did it with stretchy string and balls. Lots of fun. Let's take a look. This upper parallel, look at our price. We zoomed up here. We had this huge wide range bar. And you can see they're trying to pop it up again. They run right into the upper parallel or the reaction or the action line, whatever you want to call it. Action reaction lines and median lines are in the same class. They're the same subset, just so you know. Andrews invented action reaction lines first in the 20s, mid-20s, and then wanted to simplify them. That's where median lines came a little bit later. But they're a simplified version. Price test, again, the upper parallel or this action line. But look at the close. Price has retested two median lines. So at this point, what do? We zoomed this median line with this bar. Now we've retested it right here, the blue one. We zoomed this magenta or pink one with this wide range bar. Now we've just retested it. You see the pendulum going back and forth? We have unfinished business. Can anybody tell me what it is? Ed, that's a good, Mr. Dowd, that's a good question. Please save it for the end and ask me because that's a good question. Yeah, the green median line has not been tested. Exactly right. Okay, good. Everybody is paying attention. Good. Will it get tested? I don't know. Let's see what we get. I have an idea for a trade. But just like I did not chase price, Brianna said, let's get it. And she was joking. We got to get it now. I did not chase price. I do not chase price. I never chase price. I will not chase price. All of you raise your hand right now. I will not chase price. I refuse to chase price. Come on. I will not chase price. I refuse to chase price. I swear. Okay, good. All right. There is a time for everything. I'm going to wait a few bars before finalizing my trading plans. I need to buy a few bars. I don't have what I need yet. I'm willing to wait. I'm a cat, not a dog. I will not chase price. I like that one. Good, Michael. How you doing, Michael? Yes, I did get your email. Okay. A few bars later, what do we get? Price zoomed through three median lines. Price then came back and retested the blue median line. Then it retested the magenta median line. Then we had a couple inside bars. Now we have a wide range bar lower, and it tests the green median line. All three median lines have been retested. When price was up here, of course, it feels like it will never, ever come back and give us a quality area to get long. If we're patient, 80% of the time, it will give us a quality area to get long. It's the patience part that's difficult. Master your tools, master yourself. That's my motto. It's mastering yourself. It's being patient that's difficult. Because it's like gambling, it's like sports, it's like anything where you're emotional. And trading, it can be very emotional if you let it. You want to be in when it's moving. Patience, grasshopper. Because you want to be in at a good price. You don't want to be in at a bad price. Because then, think of all the people that got long up in here. As price comes down to test this green median line, which is, of course, where the alchemists are waiting. That's where we're waiting. These people, they've only got horizontal glasses on. They're getting stopped out. They've just got stopped up. They just lost money. Sorry. So all three zoomed median lines have been retested. You want to know, am I ready to enter orders now? I want to know, are you ready to enter orders now? OIC, I like that. Patience without becoming the patient. By the way, OIC is another gentleman like myself that studied with Dr. Andrews and a long lifetime friend. All right, so I have a couple people that are interested. I have some people who want to buy a bar, and I have some other people saying, I'm not interested. Okay, let's look at the chart. Start scaling in. Brave, I do not scale, but if it's in your trading plan, okay. I trade at one price. Keep it simple. I trade at one price, and I generally get out at one price. I don't scale in or scale out. But if that's part of your trading plan, that's fine. So the BC line defines the controlling pivot. Again, I've taken the bars off. I think I see something, and price did retest all three zoomed median lines, but price is still trading well within the controlling swing. What's the controlling swing? The controlling swing is this, when we put the bars back on, it's this high to this low, this swing right here. We haven't traded outside of it at all. And let's go back and look at that real quick. See, this is the controlling swing right here. And even though this looks like a really fascinating, this is a big, huge, powerful move, we're still within the controlling swing, aren't we? Somebody says breakout bar. We haven't broken out of anything. In fact, magenta to magenta, we're still within that range. It feels like we just went 100 miles, but we really haven't. I think I see something, and price did retest all three zoomed median lines, but price is still trading still within the controlling swing. What does that tell me? I need to be careful, okay? It's range, we're still within the range. I don't want to get all loaded up unless I'm in the right part of the range or unless I have a reason to have a position on. Let's put some bars back on. If I think I see something, what could I be missing? Can you help me out? It's on the tip of my tongue. What is it? What could it possibly be? What the heck could it be? Test, risk reward, target must be within the range, buyers, risk reward ratio, stop. You need a stop, always need a stop. You need a plan. All those are good, actually. You guys are very swift today. I like it. Energy points. Where are the buyers and sellers now? All very good. Okay, let's look. Ready? Fact. I like that one. Everybody ready to look? Let's look. Let's see what we can see. The germ of an idea is there, but price action has not matured yet, and the risk-reward aspects of the potential trade do not meet my criteria. For those of you that have followed any of my work, I was taught, I'm the last, I'm proud of it, but it's also sad. I'm the last professional trader and the last educator that actually studied under Amos Hofstadter, who died in a tragic car accident in 1978. I knew him because I was at Commodities Corporation. I'm it. Risk-reward is the engine that drives consistently profitable traders, whether they know it or not. And so if the risk-reward aspects of a potential trade don't meet my criteria, I don't trade. And those of you that have seen my work before here or at Market Geometry or read my articles know if it's not 3 to 1, if I'm not likely to make $3 for every $1 I risk, I'm not interested. So take a look. If I'm just going to buy here, I have to put my stop underneath a swing. Where's the swing low? The only swing I have is right here. So my stop order's got to be right here. Yeah, it's at least 25 pips lower, yep. Now, if I think about where the potential problems are to the upside, rare air, so to speak, I left one out. First of all, I could run into this energy point. I could run into this median line. I could run into this downsloping green action line. So that might be here, or it might be here. I certainly could run into problems at these prior highs because they were rejected nicely, right? Or I might run into problems at the top of this range. And remember, right above it, right here, and just about where the upper parallel is, we had that huge buy, and then it fell apart, and then it turned into resistance. So we've got resistance about where the upper blue parallel is. We've got potential resistance at the top of what this used to be a range. Now we're calling it an upper parallel or a action line. We might run into problems at the downslope. We've got our alchemy glasses on. We might run into problems at our downsloping upper parallel line. So if we buy here with a stop here and our profit target's here, that's at best 1 to 1. Not taking that trade. Not me. What about up here at this range? Even that's barely more than 1 to 1. And even at the parallel, even at the upper parallel in this, it's not 3 to 1. It doesn't work. There's no good risk reward on this chart, says Ryan. Ryan, you are correct. So I'm scratching my head. What does that mean? Does that mean I'm going to go short instead? What does it mean? No trade, yeah. It means I need a better stop, or I need more mature price action. Something needs to happen, but one thing is for certain. I'm not trading now. Wait for a trade process. Yes. Better structure to develop, perhaps. Yes. But right time? No. Time to stand up and walk around. Sure, Don. Absolutely. Time to break. Take a break. Get up. Go to the bathroom. Go into your restaurant. Go into your kitchen. Get a nice cold drink, not beer. Just get something. Wake up. Shake your head. You need something, but what you need isn't here in front of you. So let's see where that goes. Lines of opposing force are controlling this market at the moment. Lines of opposing force. Upsloping lines that are being tested, downsloping lines that are being tested. Those are lines of opposing force. Once price tests at the top of the downsloping action line, which is right here, right after the 2 wide range bars that created a zoom of 3 median lines, price has traded in a diamond. See it? It's called a diamond because of the shape. When you have lines of opposing force we trade in diamonds, and the diamonds get passed off, and there are specific rules to them, and we're not going to go over them today, but at the moment, price is being controlled by this diamond between the set of the green down-sloping lines and the set of blue up-sloping lines. Until this resolves itself, can't trade. Price is traded within the controlling swing that formed that BC line segment, that big long swing that I talked about, and within the large upward swing that featured the two wide range bars. You can keep that in your mind. It seems like it's done a lot, but it really hasn't done very much. It's traded within these ranges. I know it seems like if you can put yourself back in my son is 14 years old. Put yourself back in his shoes. And the parent saying, yeah, I know you want to do this, but, or I know you want to go here, but, or I know you want to go to this concert, but, I know you want to go to the dance, but. And I know it feels like I'm giving you a lot of, this is why we can't do this, this is why we can't do this. But if you can get to the point where you are very discreet and are very particular about your trading, your results will improve dramatically. That's when you start to become a consistently profitable trader. And if you already are, that's when you become much more profitable. I'm going to connect the swings. Because I want to know what it needs for me to get to an area to trade. So what do? I'm drawing in. I do my best to draw in the swings. Follow the bouncing ball. You can see the swings here. Swing higher, wide range. This is the controlling swing right here. We come out of the hole. It's a nice looking swing, but it's not the controlling swing. We trade lower, but we don't take out any of the prior lows. Minor higher, minor lower, higher, but we don't take out the interesting wide range move up, and we're still within the diamond. However, all right, I tried to explain it with words. I tried to connect the swings with red lines, and neither helped me clarify the problem. I do not ever consider volume, no. We can talk about that. Ask me afterwards, I'll explain why. Neither helped me clarify the problem. Let me try something very simple. Let's just take the bars off again. I use this all the time, by the way. If you use Ensign, for example, you just hit the B. It leaves all your drawing on. Your bars go away. You hit B, the bars come back on again. If your trading platform doesn't do that, ask them. They can do it. It's very simple. Very, very powerful. So let's take a look. Here's our big controlling swing, the BC line. Here's minor swings leading up to it. And now you can see, what do we have? The swings are actually contracting. And I don't do Head and Shoulders. I use a different shampoo. The swings are contracting. Here's our extreme high. Here's our extreme low. And we're actually trading within each one of the swings now. It's a wedgie. Yeah, absolutely. Can you see price has settled into a sideways drift? What do we want before we trade? Here. What do we want before we trade? Not just good risk reward. No, something simple. What do we need? Intention. Yeah, we need something interesting. Do we want to trade in nothingness in here and let me just take a trade and see if I'm right here? No. We got to get out of here. Look at it again. We got to get out of here. I don't want to trade in here. And this is coming down to nothing. I don't want to trade in this. Get me out of here. What price action would make you interested? Oh, sorry, let me say it with a different inflection. What price action would make you interested in trading in this market? Think about that for a second. Think about it. Big bar, wash and a rinse, wide range bar, break out of the triangle, then a retest, break of the trend line. Okay, all good ideas. What I wanted you to do was think about it. And when you trade, you should be thinking about this. If you go, well, this is a tight range. Okay, well, what do you need before you be interested? Okay? I want you to think. Every time you trade, if you're not in the point where you're, okay, I got something going. If you're not there, then you should be thinking, well, what would it take for me to be interested in trading? If you have to, draw it out. But get into the habit of thinking, what would it take? Let's take a look. This is the actual price. This is a few bars later here. I might not cheat on you. All right, see where we're at? Everybody got it? Burn it in your mind. Come on. Yes, Robert, you got it absolutely dead right. Burn it in your mind. Everybody see where we're at? Then we're gonna go about 10 bars ahead. Okay, here we go. It's magic. Boom. Where are we at now? We're at the lower parallel. And Andrew says the price comes off the median line and heads lower. If it's going to run out of energy, it should run out of energy at the lower parallel. It'll do one of three things. It will accelerate to the downside. It will consolidate, and I can tell you, you can forget about that. That's only about 12% of the time. Or it'll stop here and reverse. Is there anything? Yes, it may break down. That's what I said, though. It's one of the three. It can accelerate to the downside. It can consolidate, or it can turn around. Is there anything, as we get to this blue lower parallel, that makes us think that price may run out of energy here and turn around? Not that it's a wide range bar. Prior buyers, yes, absolutely. We have prior lows over here. And look at how nice it was. We had a wide range bar lower, and then all the closes afterwards are higher. And then we had intent out of the hole. You see that? This is like an advanced peek of what we should find over here. Look at it again. We come down to this area, which is the bottom of this range. It's the lower parallel, if you will, or the reaction line of this magenta action-reaction set, or it's the doubling of this range. When we get down here, we never close below it, and we get nice closes on their highs, and then zoom out of the hole. There were buyers down here. So we have in our mind, hey, you know, last time we were down here, there were some serious buyers. And when I drew this median line, and I look at it, of course, I like the BC. I like the touches on the handle. We're coming off the median line. We're heading lower. Price should run out of energy at the lower parallel. We're not below these prior buyers. And price didn't stay down here very long. Let's see what we get. Price is at a null point. For those of you that are not only alchemists, but if you're physicists, I don't believe null point was in the alchemist book, but we'll put it in there. What does that mean? All things are possible at a null point. But in this case, this is a special one. If price does not make a new low, and if I can find a high probability trade entry with good risk reward, I may be able to find an entry that will allow me to catch the next wave higher. That's what we're trying to do. We're trying to rip money out of the market. Null point means all things are possible. It's an energy point where all things are possible. Now, take a look. Null point. Unless price, good, let me speak again, good English here. Unless price breaks below this the lows here, the power of this null point may work for me if I have a reasonable stop loss. Because price here, null point by its very nature means that price is as full of energy as it can be. All things are possible, and it's as loaded with energy as it can possibly be. If the null point doesn't work for me, it's because it takes out the prior lows. If it does work for me, and it respects the lower parallel, I should get a nice pop out of this area. What do you think's on my mind? I mean, to put it in a few words, I like the long side because if I can find a stop that makes sense, I can identify my risk, and I can identify an opportunity. That's what we're always looking for. Remember, price does not have to do what I hope it will do. Unfortunately, there's not a phone number you can call and say, could you have the euro dollar go up now because I want to get long? There's no 1-800 number. Actually, I should start that. Wonder how many people would call. And then just, not do anything, but charge them 99 cents a minute. Isn't that what they do? Anyway, I can only observe, record, and draw conclusions. And if everything fits my plan, I can place orders into the market. That's all I can do. So let's look. Those of you that were concerned about this bar and its close on its lows, and that maybe we took out the lower magenta, lower parallel, again, these are our major buyers down here. We haven't taken them out. We also have the blue median line set. We're at the lower parallel where price should run out of energy. Now, I'm giving you the next bar. Take a look at it. Everybody see it? Bonjour to two. Everybody see this bar? This is called great separation. We leave double bottoms. We're still above the prior lows, and look where we close. This is as much intent as you're going to get. Do I ever use candles? No, I don't bother. Simple. Okay? I can't remember the names. I know Steve Nissan very well, and I was probably one of the first people that he ever talked to about candles when he got back from Japan. But doesn't work for me. I like simple price bars. All right, so this bar right here is about as good of an intention bar as you're going to get. And even though they're not the same length, they're relatively close, double bottoms. These are like mirror bars. Close on its low, closes on its highs. Is there anybody that wants to be short now? You know, I am wrong at times. At least a third of my trades are losers. Anybody want to consider a long trade? I'm just asking yes or no. I'm not. I don't need a whole description. We'll get to that. Is there anybody that says I don't see a trade? I'm not interested in playing. I know one of you are. Anybody else? Anna says risk reward is bad. Okay. I will consider that in a moment. I'm not asking you to give me a description. I just want to know, are you interested in trading? Okay, I got some no's. Okay, good. Got some, I guess, good. Got some no's, got some yes. Okay, good. That's good. With that great close well above the lower parallel, I am willing to put in a limit buy order with an initial stop loss order 7 pips below the prior low. Why 7 pips? We do all kinds of statistical analysis, and we know that if price goes more than 7 pips past the prior low, that's more than noise. It's significant. So my stop has to be at least 7 pips below that prior low in the euro-dollar futures. So I'm willing to buy here. Now here's my question for you. Ready? It's got to be at least 7 pips below here. Okay? You with me? Is the initial stop loss, should it be here? Or should it be here? Because remember, we had major buyers here. This one meets the 7 pip criteria. They both do. If you can afford number 2. Okay, I like the Robert, very good. This is a trick question because they're both okay. But the more you can afford, the better off you are, of course. Right? The other thing about going for number 2 is you better be expecting a significant move because that's also changed your risk-reward potential, right? And Aaron exactly says, depends on if you're aiming for the median line or the upper median line parallel. Exactly right. Depends on what you're looking for. All right? Those are the considerations. Before I go on, and we're not that far from the end, then we'll have questions. Is anybody lost? We are still within the green lines, and that doesn't worry me now. Excuse me. Here's our, think about it this way. This was our big wide range zoom that was the top of those green lines. So you can imagine it running right here. What market are we looking at? We're looking at Euro FX against the dollar. Okay. Nobody's lost. That's good. Oh, that's a good observation. Robbie says number 2 is almost at warning line 1. Good point. Yeah, it is. It would actually come in down around here. At some point, though, you have to say, okay, I can afford this. Can I afford this? Can I afford the warning line, which is in here? Can I afford the second warning line? I mean, I guess you can't see my cursor if you move further down. At some point, you have to say, look, I didn't know it. I can't. Don says, I'm ready to rumble. Okay, let's see what we got. Or will I? Which stop loss order makes more sense here? We're back to the argument of scrunching in charts to see the key support or resistance that we talked about in the beginning. The current, this is really important, pay attention down here. The current C pivot on the upsloping median line is a valid swing low. Let me say it again. The current C pivot on the blue upsloping median line is a valid swing low. So why not put our stops right underneath that valid swing low? Yes, you can make the argument that there were buyers quite some time ago, about another 15 pips below the current C pivot. But how long is the memory of these traders? Are they still there 15 pips below that C pivot, or have they changed their orders? You know, I say in the premium sessions in market geometry all the time, do we have to check the low in, the euro didn't start trading until January 2000. Do we have to check the low in 2001 before we put our order in? How far back do we have to go? I feel when trading charts based on 20-minute bars, the market remembers the last significant swing and roughly 2 to 4 days of data. For this particular trade, the null point is right below my entry area. I feel it warrants a stop loss order 5 to 7 pips below the C pivot, but at least a total of 15 pips from the entry price. In other words, when I trade the euro futures, euro FX futures, I never use a stop less than 15 pips because of the noise in the instrument. So I want my stop loss 5 to 7 pips below the C pivot, but at least 15 pips from the entry price. I don't think it warrants a stop loss order that's 35 to 40 pips or ticks below the entry price. I don't think it's meaningful. Even though there were buyers there some time ago, how do I determine noise? We did a seminar, and the DVD is is actually available on the webpage. There's a whole, it was a 9-hour seminar. We did a 2-hour session of looking at average true ranges and how to determine noise from actual market structure. I don't think it warrants a stop 35 to 40 or below the entry price. I would rather use, again, the current market action. You can't miss the title. It's, I'm sorry, it's on the tip of my tongue. When you go to marketgeometry.com, it pops right out at you right now because we just put it up. You can't miss it. And drop me a line if you can't figure out what it is. TimothyMorridge@gmail.com. So remember that there were major buyers here. I want to buy at the lower parallel. The initial stop loss is going to be here. To me, this stop loss is irrelevant. I know that there were major buyers here, but they were far enough back there that they're out of the market's memory as far as I'm concerned. Okay? I put my order in after this bar. And look what price does. A whole lot of nothing. After 5 bars, I pull my order. That's my rule. More than 5 bars pass, so I want to see a new test before buying a retest. So I watch price test this lower parallel again. Look at the close. Another great close. Test it, closes in the middle. Good 5, 6, 7 ticks above. That's good. I'm going to draw on the last swing. Yes, it is very late in the morning, but lately, unfortunately, I have been I have been up and trading in all kinds of strange hours because I've been doing, I'm writing some new things, and we have some new things going on at market geometry, and I'm trading. I trade when I'm awake, just the way it is. Anyway, why not draw on the last swing? Major high. This was that. Remember this pop out of the hole? What does it give me? Well, at the moment, it's irrelevant. Oh, if I throw the first warning line in, though, hey, pretty good confluence with the blue lower parallel. And, again, beautiful close on this bar. So now we have lines of opposing force that are coming together that makes this an energy point. So I'm really starting to like this. Buy at the lower parallel, initial stop 15 pips below the entry and C. So it's got to be at least 15 pips away, and it's got to be underneath the C point by 5 to 7 pips. Everybody with me? What am I missing? You guys are good. Yeah, I got no profit target. If I don't have a profit target, what don't I have? Risk reward. Absolutely right. Okay, I have market structure that I like. I have a stop that works for me. Now I need to know, where do I think price is likely to go, and does that risk reward work for me or not? Otherwise, no trade, because plan every trade down to the very last detail. Okay, it's time for you to take some ownership of this trade. Not me, you. You still here, Anna? Hey, Susan, how are you? Still here, Anna? Come on. Everybody has to take ownership. Here we go. If we get long, I'm long. My order got hit. But if we get long at 130.41, and our stop is 15 pips lower and 5 to 7 pips underneath the C point, which it is, do we want our stop at this congestion? We're looking at likely areas the market could stop on. 2, do we want our order at these prior highs? And by the way, if price takes a long time to get there, it might also be the median line. 3, do we want our price profit target to be right at prior highs and also the top of the magenta range? Excuse me. 4, do we want to be at the upper parallel? So what do you, just pick the number, just tell me your number. 1, 2, 3, 4. All right, if you chose 1, okay, I got them, hang on. If you chose 1, you need to watch some more of the prior seminars that I've given here at IB, or come over to Market Geometry and read some of the articles. They're free. MarketGeometry.com, free info. Look there. If you get long here and your stop is here, you're only getting about 1.5 to 1 risk-reward ratio. You will not be a profitable trader long-term if you trade with a risk-reward that small. Period. If you chose number 2, let's take a look. Eyes are not that good. Looks like 80, 130.80. So we're going to get 39 pips We're still not at 3 to 1, are we? We're close, but we're still not 3 to 1. If you chose number 3, that's not a bad choice. You're now at 3 to 1. That's more than acceptable. And it has some logic behind it. Prior highs, top of the range. All good with that. So those of you that chose 3, all good. If you chose 4, what does Andrew say? If we go from the lower parallel and turn, we should get to the median line. If we don't turn lower from the median line, then with 80% probability, where are we going? The upper median line, exactly right. 80% probability. So this trade only works for me if I think it's going to get through the median line. And if it gets through the median line, the profit target that makes sense in terms of statistics and physics and thermodynamics is the upper parallel, period. I never scale out, no. I don't scale in, I don't scale out, nope. The reason why is because your risk-reward falls apart. And risk-reward is the key to being a consistently profitable trader and having very, very good rates of return. All right. Here's my choice. Good friend of mine in Chicago, one of the first guys who attended one of the seminars I gave at the CME and the CBOT. He used to call this going blue to blue. Number 4, blue, the lower parallel, to the upper parallel, blue to blue. That's in Chicago language. Blue to blue. Andy. How are you, Andy? I know you're out there somewhere. So let's look at it. I want to get long at 130.41. And in fact, actually, I'm filled. My stop is 130.26. I literally run a vertical line up to the upper parallel and say, okay, where's price at that point? I'm risking 15 pips to make 67, so the risk reward is 4.5 to 1. $4.5 to 1, yeah? Got to be at least 3 to 1 or I don't trade. Anybody have a problem with this trade before I move on? Excuse me. Okay. Somebody says, why do you think it would go over the pink line? Let me explain it again. According to Andrews and according to the statistics that he did in the 20s and 30s and that I have replicated millions of times now that you can use computer power, once you break above the median line, 80% of the time you will make the upper parallel. 80% of the time. I know that there are going to be some sellers here, but I also know 80% of the time if I go above the median line, I'm heading right to the upper parallel. So since I have my alchemy glasses on and I can trade slanted lines, I'm willing to do it. That's what I think. That's where I think it's going. Do I move my price when my stop when price meets the median line? It depends on the price action. Let's see. I'm showing you real trades, so guys. So you know, if there's a chance to move a stop, I'll show you. Okay. Price made it to the median line. So those of you that chose, there you go. It's kind of almost profit target 2. Price made it to the median line. Now you have to ask yourself, if you're long, is this as far as price is going to come out of the hole? got a yes, I got a no. Can't tell. Okay, how about that? Would you hope not if you're starting? You would hope not. Okay. Well, first of all, never say hope if you're trading. We don't do that. We don't hope and we don't pray. I got a question for you. If price is at the median line, what do you have to do at this point? Yes, I'd like to box in profits, but I can't yet, right? Break even. Yes. Or higher, but there's no place for me to go higher. Unfortunately, there's no swing yet. This may be a swing high, but I don't have a swing low yet. So there's no orders that I can hide my stop under. So the best I can do is just go to break even and say, okay, look, if this is a lotto, it's either going to take off or it's going to come and break me out at break even. Okay? Or, believe me, if there was another place to put a stop, I'd do it. But there's nothing I can do. Andrews 101 says price will make it to the median line 80% of the time. Price made it to the median line and turned lower. What are you doing with your stop loss orders and or profit orders? I just asked you the question. You should be going to break even. Are you at break even? The long at 130.41. I am. Now look at the next one. You're long. You've got a nice profit. What are your orders? Look what price did. Tested the median line, came back, regathered itself, and popped out of the hole. It zoomed this median line. It zoomed this upper parallel that everybody's worried about, the top of the range, and it's closing on its high. What are you going to do with your orders? Yeah, boom is exactly right. Someone says it's going to pull back to the median line. Okay. What's your order? Do you want to just stay at break even? Do you want to put a stop profit below this small pivot? We believe, Shane and I, that these wide range bars actually act like swing low, swing highs, like they have pivots. You want to put a stop 5 to 7 pips below the low of this wide range bar? That way, if it comes back to the median line, if the median line holds at least, you'll still be in play. But you've locked in some profits. What do you want to do? Oh, well, you know, there's a good one. Dynamic risk reward. We don't have time to talk about it, but that's a tremendous comment. You know what? I think Barbara's left, but I think we'll do currencies again next month, and we'll talk about dynamic risk reward. We haven't in a long time. So I'm just going to tease you. I'm not going to tell you what it is, but selling. Anna wants to sell in reverse. Oh my God! Put a stop at the median line. It's good when it's in your favor. Absolutely. Move stop to just below. So everybody's got in their mind what they're going to do, right? All right, somebody wants they're just going to take 50% profit. Okay, I don't do that, but you can. But make sure that it's in your plan before you take the trade, okay? Don't just wing it. If you wing it, you're really going to be a loser. I'm sorry. You need to plan your trades and then execute the plan. Period. Okay? Everybody's got in mind what they're going to do. Here's the honest truth. All of these are good ideas. They're all good. If you want to let it swing, stay at break even. That's fine. If you want to protect it and make sure you get some money out of it, but if it pulls back, you don't want to get stopped out and not get something for all this. This is the only pivot you can lean on. If you want to get sexy, so to speak, Shane and I both believe that these wide range bars act like swing highs and swing lows. Put your stop 5 to 7 pips below this low and say, okay, well, you know what? At least I collected this amount. And what's in our favor? Andrews 101. It's going to hit the upper parallel. But all three of those are good choices. Choose your poison. It's fine. Now you've taken some ownership of this trade, okay? Why 7 pips instead of 15? 15 is a total amount of a stop in the initial trade. 7, past market structure, is past the noise. Mr. Dowell, I don't know if it's Ed Dowell or it's E. Dowell, but 7, it has to be 7 pips to be past the noise, okay? We just know that from doing statistics. So the 15 is only on the initial trade. That's exactly right. Yep, bingo. Needs to be 15 at least, and it also has to be 5 to 7 past the structure you're using. But yes, 15 minimum, but only on the initial. You've got it right on. Price zoomed above the upsloping median line with a huge wide range bar and closed near its highs. Andrews says price will make it to the next most likely line, quote unquote, 80% of the time. But you have a very nice profit in this trade, and there are no easy stop profit areas because price has climbed vertically. You've had a tough. Let's put yourself in these shoes. Ready? You've had a tough week trading. Say you made 3 or 4 trades, and if you make this one, it's going to get you out of the hole. So what are you going to do with your orders? George says, take your money and run. Sahari says, take your money and run. I have no problem with that. Matt says, let them be. Just leave your orders alone. That's what I would do. I would just go ahead and execute what my plan was. George says he'd sell at the market. Okay. Robbie says, it's close enough to the upper median line, I'd take my profit. Okay. Can't go broke taking a profit. Yeah, Ryan, actually, you can go broke taking a profit. The DVD that I'm speaking about, which is advanced position sizing, that's what it's talking about, and risk reward. It's the second seminar. We prove conclusively, using million of alterations, that if you take small profits and don't have good risk reward, you will go broke. Not likely, you will go broke. Yes, my wife, Anna, my wife is the risk manager. You're exactly right. So anyway, there's no way for us to box in profits, but we gave 3 possibilities. Some people want to take it at the market. If you took money on this past one at the market, you're past 3 to 1, so it's not going to hurt you. The only problem with this, just taking money at the market, is it becomes a slippery slope, and every time you have a nice profit, you get a little nervous. You'll start taking profits. And if you're working underneath market structure and able to work this up, you may find a trade that you started out with the risk reward was 4 to 1, and you end up harvesting 15 to 1. So you need to be careful about changing the plan because it's a slippery slope once you start to do that. So I'm out at the median line, period. Thank you. Worked. All good. I risked 15 pips, netted 69 pips because it was an upsloping line, and I kept moving my profit target as the line moved up for a realized risk reward of 4.6 to 1. Okay? This is an intraday trade. It's not a 2-week trade. They're 20-minute bars. Would you have managed this trade like this? There were lots of opportunities to make this trade, to manage this trade, and not manage it the same way and still make money. Do I front run the target median line price? Sometimes I go 3, 4, 5 pips inside. Sometimes. I really like it, though. It's a great feeling if you have it right at the line and the market takes you out. It's something pleasing about that. I like to be taken out at the line. What do you usually see of the shot? I can't draw the shift, and Robert, I have to be honest with you, I'm getting tired, and I want to be able to take other questions. So the shift doesn't come into play here. We'll do more. We're going to do currencies next month, and I'll try and do some dynamic risk reward and some work with shift median lines and some other stuff for you. There were lots of ways to manage this trade and make it work. And that's why I tried to make it a little interactive, and we'll try and do that again next month. So that you think, I want you to think about it, and this is how you should be trading. Okay, I got where could I put my profit order, and pick 3 or 4 spots, and then try and justify them, and try and think what it means and why you would do it. Okay, so you've seen my trade based only on the recent price action and the last major swing. Now, if Harvey says 20 minutes versus 15 minutes, there's nothing wrong with 15. The reason why 20 minutes is 240 minutes is the hedge fund gold standard. 20 divides into it equally. That's all. So it's about the same. Until we draw more red warning lines and hide the stop behind, we'll talk about that next month as well. But so there's no 15 to 20 minutes, no different. Okay. Now, do you remember how we began this presentation, everybody? Well, before Occam's razor. You don't remember? Yeah. It wasn't 4 days on a chart. It was like 40 days, right? Tons of data. Remember that? 1 trillion days of data. In fact, I don't remember it this well because I did this at 2 o'clock in the morning on Sunday, but yeah, there you go. You could have found the confluence here, and you might even have found the long trade right here. You can trade with this data on your chart, with this much data on your chart. But do you really need it? And now that you've seen what it's like to actually work in close with the bar so you can see where the stops are, or excuse me, where the highs are, what the range of the bar is, how far it broke below a range, but if it closed back above it, you can't see any of that stuff on this chart, can you? Which would you rather work with? This data or this data? Yeah. Both? No. Matt, both is not an option. Let me just tell you. If you use both, you will talk yourself out of too many trades. You'll just get confused. Trust me. You're much better off in this world, and everything you need to know is right here. And we'll work again when we do next month. Again, you'll see we'll use this kind of data. In fact, I will commit, unless Barbara tells me I can't do currencies, in which case I'll do it 2 months from now, but I'm sure she'll be fine with it. I will commit to using 20-minute bars. And we'll use the same amount of data so that you just see this is what I use all the time. If you use 5-minute charts, do you still use the minimum stop of 15 pips and 7 below the previous? Well, Victor, actually, you have to actually do the average true range and take a look at noise and all those other things, but it's actually fairly similar. The problem with that, though, is the 5-minute swings are not the same size as 15 or 20-minute swings, but you'll have to do that exercise. Let's see if we're done here. Okay, so you've seen my trade based only on, I already did that. There's what we started out with, and you saw what it was like in close. It can be done with months of data on a 20-minute chart. I've done it. You've probably done it or tried to do it. But I'd argue that it's much easier to harvest your piece or grab your piece out of the market when you pay attention to the relevant data, not squeeze in all the data that the vendor offers you. You don't need 2 months of 20-minute bars to trade. You need a couple days, the major swing, and then the data sets. That's all you need. And questions. So, Cynthia, that's for you. Hey, OIC, wait 1 second. Wendy, you're saying I'll give him a big hug for you. OIC, always great to see you. I appreciate it, and I'll give Sean and Lucy a hug for you, buddy. I appreciate you coming. Thank you, my brother. Okay, sorry, Cynthia.
Well, I think Tim is alluding to it's now my turn to come in. I do have a piece of business before Tim gets to the rest of your questions that I do need to run, and that's a poll. So notice on your screen I'm going to be opening up a polling panel with 3 short questions on it. Management does ask that you respond to these based on whether this information is relevant to your trading needs. Now, 2 of those are actually multiple choice questions, so please make your selections, and there's also a Submit button down at the bottom right-hand corner of that panel. Now, you'll notice that number 2 has an input field. So if you have comments or suggestions that you might like to have covered in upcoming webinars, that's a great place to put them. But otherwise, if you would, please go ahead and fill this out and then click that Submit button. Now, it's only going to, you'll have to type quickly because we have only about 5 seconds more, so everyone click Submit. Now, also do want to let you know, if I did time out because the poll just did end, you can always send those comments or suggestions to me at webinars@interactivebrokers.com. Now, because the poll has ended, thank you everyone for your response. Notice that you can close that polling panel by simply using the X in the title bar, then double-click the chat panel to reopen up the chat and send Tim any questions that you might have at this point. So back to you, Tim.
Thank you so much. You know what? That poll thing goes by so fast. I swear to God. There's only 3 little questions, and it's always like, oh, there's so much pressure. What am I going to do?
Well, I do try and keep it short because you're the headliner of this. So we get business covered, and now back to you.
Okay. Let me see what I can do here. And I don't have too much time because, like I said, I am actually going to go do a video cast. I have to go to another high school and then do a video cast with a few high schools that want to band together, and they would like me to come several times a month and teach. I'll do it free. Teach, technical analysis to high school students. I just think it would be great. I'd be honored. So anyway, do you ever exit? First of all, thank you all for taking time. I'm sorry, I'm speeding a little bit. I appreciate you guys. I know you're all busy, and we've already done a couple hours, and I really appreciate you guys taking the time to come and hear what I have to say. Do you ever exit at a price other than your stop or profit target? That is, you see something on the chart that makes you pretty sure you were wrong, or, for example, the price breaks down below a minor low or median line, would you exit long and just let your stop get hit? If you would exit, how do you pick your exit price? Charles, the truth is, I plan my trade. I put my orders in. I may move my profit target up or along a slope line. I may move my stop profit up underneath new structure. I will never move my stop loss, ever, ever, ever worse. And I never just exit because I see something, ever. I just let my orders get hit. That's how I trade. And I keep track of it on paper, and the reason why is because then at the end of the month I have a meeting with myself, and I can go over all of my decisions. I even keep track of all the trades I stock because maybe I missed 4 really wonderful trades this month. I want to make sure that it's not a trend, that there's something I'm missing that I should be addressing. So the only way you can do that is if you keep track of what you're doing and then observe it. Let's see. From your example, when evaluating risk-reward, how do you evaluate whether price is likely to exceed the median line and go to the upper median line parallel? Excuse me. It's a wonderful question. The reason why I felt in this example, and this was a real trade, that we would go to the upper median line is based on 2 things. First of all, we were down at price support. We were down at the null point. The price was full of energy, okay? We were either going to break below the C pivot, which was support, and head quite a bit lower, in which case I would just get stopped out for my 15-pip loss, or it had a lot of energy. It had been trading in that range for quite some time, and even to stay within the range, it would make it past the median line, which tells me, according to Dr. Andrews, it should make it to the parallel. Let's see. You guys can hear me, right? I got this strange thing in the background. Anybody? Okay. All right. That's all. Not too many I've done because I don't want the questions to. Okay. So you wait for the candle or the chart to show a bullish response and then wait for the next entry. Do you lose less money, but do you miss more profitable trades? Yeah, if you use a test retest, which is what I showed today, and I don't, for example, when I trade grains, I don't use test retest. I just trade right on the median line. But yes, if you use a test retest, you'll have about 25% fewer trades, but they will be more profitable by about 10%, your percentage profits. profitable trades will go up. Good question. The C of an upward pitch forward is always a higher low. Actually, it's not. You can draw. It depends on the geometry of the prior market structure. How do I get my kid in your next high school class? Rob, you know what? I don't actually have the details per se, but I can guarantee it won't be through me. You got to remember, we're in the world now of stalkers and all that stuff. So, you know, no state is going to allow somebody like me or anybody over the internet to contact a kid. But when we get to the point where we've cut the deal, we'll tell you how the high schools are banding together, whether it's a state or a group of states to get together, and then you can find out whether your high school is involved or how they can get involved. Because it's as easy for me to help 30 kids as it is, you know, with fifth graders this year, I'm at 25,000 and change. It's just as easy as doing 50. It's the same. Have I ever traded with Renko bars? Sure, but I think straight price bars show market structure better. I'm all about that. Is there any pattern to your losing trades? Yep, there absolutely is. Any idea what the biggest pitfalls are besides the discipline piece? It's EDAL, but I'm just going to call you Ed. My losing trades, and I've shown them at market geometry before. My losing trades are the most boring thing in the world. They're almost always the same. I always get stopped out if I'm wrong in the next 2 or 3 bars, and it's basically just a nice wide range bar. It just takes me out. You know, we talked about the null point here. Basically, I'd be wrong about the null point. I've got a 15 pip stop, and like 2 bars later, it goes 45 points lower. That's what my stops look like. I'm just wrong. That's what stops are for. I'm not afraid to get stopped out. That's why we use stops. Let's see. I have traded with Renko, yes, but I don't trade with it, no. Oh, you're starting to use Renko. You like it because it takes time out of the equation. Well, try ticks. Try tick bars instead. They're even better than Renko. Okay. Renko is a forced pattern. Ticks will take time out, but it won't force them into a pattern. Let's see. Why not consider volume? Oh, yes, you asked the question earlier. Well, there's 2 things. Unfortunately, and again, I'm a whale. I don't know if you guys know this. I can trade outside of the exchange. Did you know that? I can trade futures or cash foreign exchange outside of the exchange. So my trades don't show up. So you may think that you're seeing all the volume going on at the time, but it doesn't show up. So let's say I do 10,000 contracts in the bonds. If I do them the correct way, it doesn't show up in DOME, and it doesn't show up in your volume bar. And don't you think that kind of skews the whole idea? So I have no use for it. And plus, I've done a lot of studies. And any of you ever heard of market profile, which is based on volume, ticks? I was the original investor for market profile in the very early 80s. I loved it. I think it's a great idea. Unfortunately, because of A, flawed volume reports, and B, the inability to get enough information quickly enough, it didn't work when I was involved with it. Which is better, futures or currencies to trade? You mean currency futures or cash forex? Is that what you mean, George? I would trade either one. I still have my CME code is hanging right behind me. If you can see, we call it the Bat Cave. My badge is Thorn, T-H-R-N. My coat's right behind me. My kids both have coats, by the way, and have been on the floor a number of times. I trade the CME all the time. I'm still listed as my official title is I'm the Foreign Exchange Pro for the CME. And what I love about futures are they're transparent. Okay, you can actually see all the volume going through. You can see, it's first in, first out. So you even though somebody else wants to buy 10,000, if your bid was there first, it's et cetera, et cetera. Cash foreign exchange, you have no idea what's going on. Most of you, if not all of you, are not large enough to be trading with one of the 5 ECNs, the market makers. I am, but almost none of you are. So they can stop you out when the market was never there if they want to. There were no real rules. I mean, they have to be a little careful now because the CFTC and the SEC are watching. And it's getting better, but it's not as clean as the CME. If the CME, if your stop is at 15 and the low was 16, you're not stopped, period. So I like that. The only thing I don't like is if you have a very small account, of course, you have to trade the CME amounts, and the minis are, and the currencies are just not liquid enough for some of you to day trade. That's the downside. So if I had a small account and I was learning, I might consider, not to help Cynthia out here, but I might call Cynthia and say, I'd like to open an account, and they have 2 classes of accounts, and they treat people with smaller amounts. They'll let you trade smaller amounts, and they treat you quite well, and that way you can go ahead and trade and risk. So you're only literally risking a couple dollars on a trade, and that can really help you learn versus, 150 in the currency futures. So, but am I a CME guy? Absolutely. We call it the IMM. That's the old days, International Monetary Market, but I'm a CME guy through and through. But I trade cash foreign exchange all the time as well. What else we got? Are we low on questions, Cynthia?
I think you've been doing quite well here, Tim, but we are coming towards the conclusion of today's event. So I'll give you a moment here to scan through, but if you don't see any other questions, we are going to be concluding our event. But what I also want to mention is that there will be more of Tim coming up just a month from today on March 14th. He'll be back with us as he is each month on the second Thursday of the month for another presentation. So please mark that down on your calendars, and we'll be working on a description and try and post it by the end of this week. So you can also check the IB website under Education menu. There's a webinars link, and you can locate all of our upcoming events right there. But at this point, I would definitely like to give Tim a big hand of applause, and also thank you for today's gift from the heart. I think it's appropriate that it's Valentine's Day, but Tim, the time that you have spent with us is a wonderful benefit for all of us. So thank you for the generosity. And I also have to thank everyone who's been on today's event, because you've stuck with us this long. So that lets us know that there's definitely an great interest here. So don't forget to come back and join us then on March 14th. But also let me not forget to thank the CME, because it's their dedication to educating traders that actually makes all of these events possible. So thank you all. And most definitely to Tim. Tim, my heart goes out to you, because you do such wonderful work, and thank you so much for today. Oh, look at Richard. I don't know how you did that, Richard, but I love that, the little heart there.
I know.
Yes.
I love it when people do that. I can't figure out how they do that. Cynthia, do you know this is our 5th year anniversary?
Oh my goodness! Well, and many more years to come too, I hope.
Absolutely. Okay, I got a question for you.
Okay.
Barbara said to me privately, and you just intimated it, you need a description like now, right?
Yes, I do. We've got some advertising, some print advertising I'm trying to meet a deadline for. So
I'm going over to a place, Embry-Riddle University, which is down the street here. It's the NAS, where they teach people from NASA. That's where the high schools are going to do the video thing with me. When I get back, I will put it together. You don't have a problem with me doing currencies, do you?
Oh, absolutely not. No.
Barbara's not here to vote, so I think we've got a quorum. All right, so I will write a description for you and get it to you this afternoon.
Okay, and while you're doing that, I'm going to figure out how to go back to high school again.
You know what? I'll give you the link, though.
Thank you. All right, well, I want to thank everyone else here for your participation today. And by the way, we have been recording today's event, and you'll all get a direct link to today's recorded playback. Plus, be on the lookout for a copy of Tim's slides as you exit today's event. It's in a PDF format, so you can feel free to either print directly from there or simply save a copy to your machine. So, and Ryan says, you're the man, Tim. Thank you. And I think that's an excellent way to wrap up today's event. So thank you, Tim.
Thank you all so much. Cynthia, thank you. I give you a big kiss if I was there. I appreciate it. Happy Valentine's to you, darling. Give your husband a hug for me. And everybody, thank you for taking the time. Again, it cut me 2.5 hours out of your day. I really appreciate it. I know you guys have other things to do. So hopefully it was interesting and informative. And I hope to see you all in a month. It's going to be a month, literally.
That's it. Well, thanks, everyone. Have a great day. And please remember, trade smart all.
All right, take care.